Hello, everyone. Welcome back to Financial Clarity for Doctors. This is Rochelle Van Der Zanden here, as always, with Corey Janoff today.
Hello, hello.
Hi. So today we are going to talk a little bit about a kind of touchy subject for some people. We wanted to talk about permanent life insurance. It's one of those things that a lot of people love to hate. And I understand, I feel like we hear a lot of stories about it being purchased maybe inappropriately or sold inappropriately. And we've touched on it in passing a few times, but we just wanted to delve into it and talk about it in more detail. I think there are a lot of times when it's not purchased appropriately, but there are some times where it can be appropriate and it can potentially be an asset to a financial plan. So we just want to give you guys all the information that we can today on what permanent life insurance is, what it can potentially do, so that you guys are well prepared to either think about that or maybe, if someone is trying to sell it to you, at least have some information so that you can make a good decision there. So without further ado, it can be a pretty complicated topic. So we're going to start with some basics, and Corey is going to start us off.
Yes. And, so we're clear, we're kind of on the same page as most of you are who have any familiarity or understanding of permanent life insurance. In most cases, it probably is inappropriate. And that's where it gets a bad reputation, is because it's often oversold by life insurance agents to people who have no business buying permanent life insurance, and they don't realize it until years later, and they regret their decision. So super important that we understand when it could be useful, the scenarios where it does potentially make sense. And there's a reason it exists. There are certain unique scenarios where it can be very beneficial to help someone ultimately achieve their goals. And that's, if you've listened to this podcast before, that's what a resonating theme is throughout, is what are your goals? What are the optimal ways to go about achieving those goals? There's often more than one way to get there, but in some scenarios, certain avenues can be a little more effective than others. So like Rochelle said, let's start with the basics. What is permanent life insurance? Well, when it comes to life insurance, there's a lot of different types out there: whole life, variable life, term life, adjustable life, index, universal, a lot of different combinations of those even. But at the end of the day, they all fall into two categories. There's either temporary coverage or permanent coverage. Temporary coverage is called term insurance. You've probably heard of that before. It's the simplest form, very straightforward. Typical term policies have a set number of years that they last for, or maybe they go to a certain age, but a common scenario would be 10, 20, or 30-year term lengths. So you get a policy, it lasts for, say, 20 years. After that 20 years is up, it expires. Well, it technically doesn't expire, but the cost shoots through the roof, so no one would ever keep their term in place after that time period. So you're getting it for a short period of time. And most people don't need their life insurance to last forever. They're just getting it to protect the family while the kids are in the house, or until the mortgage is paid off, until they reach retirement. By definition, once you're financially independent and can afford to retire, the odds of you needing additional money in the event that you die are pretty slim, because we don't need any more money if we can afford to retire. So, the need for life insurance, you need to have a really compelling reason there to maintain your life insurance beyond that financial independence point in time. And we'll go through what some of those reasons might be. But long story short, term insurance is covering a need for a defined period of time. It's the most appropriate form of coverage for most people. And conveniently, it's also the least expensive form of
Which is
coverage.
why it's probably the most appropriate for a lot of people.
Exactly, yeah. So,
Yeah.
if you're talking to the majority of Americans, they can't afford to get enough death benefit with a permanent policy. It's cost prohibitive. Most people need a large amount of coverage, millions of dollars, to provide for their family if they were to kick the bucket in an untimely fashion. And the only way they can afford that is through a relatively inexpensive term policy. And sidetracking here a little bit, the ability to qualify for life insurance is based on health, and the cost is based on age and health. So, in some people's scenarios, they may not be able to qualify for coverage, or it may be very expensive just given their background and health history. So the cost can really vary widely for individuals, but regardless of the scenario, term is most likely going to be the less, or it will always be the less expensive option for you individually, but compared to someone else, it might be more expensive than someone else's policy just given their background.
Yeah. And I think if you think about it from an insurance carrier's perspective, if they're, giving you a term policy, they only have to pay you if you pass away within that set period of time. But if they're selling you like a permanent life insurance policy, you could potentially keep that forever and they're on the hook for that death benefit. So that's where it becomes a lot more expensive.
Yeah, as we all are aware, we're going to pass away at some point in time. It's just a matter of when. So with those permanent life insurance policies, it's just a matter of when the insurance company has to write the check. So they have to charge more for that policy, which makes sense. And we won't get super in depth into the weeds of all the different types of permanent life insurance policies and how they work, but just a general overview. Whole life is probably the most well known, and people often refer to permanent life insurance as whole life insurance because it lasts your whole life. But in reality, whole life is one subset of the broad permanent category. There's other types like variable life and adjustable and universal. Again, they all can last indefinitely. Whole life policies traditionally, and there's a lot of different iterations of each of them, so it can get kind of complex, but traditionally
Definitely.
speaking, whole life policies are fixed, guaranteed, exactly what you're getting. You pay a set price, you get a set death benefit amount. It often will increase over time. They can be structured a bunch of different ways, but it's basically you want to know exactly what you're getting and know exactly what the cost will be, and it's all laid out for you. Variable life insurance policies. So I guess taking a step back, with all permanent life insurance policies, you have the death benefit, the premium, and then there's this thing called cash value within the policy. And as time goes on, as you age, the cost of insurance goes up. So what a lot of people will do, rather than pay an increasing amount every year that goes by, they might want to just, for budgeting purposes, pay a fixed amount. And that fixed amount early on might actually be more than what the actual cost of insurance is. So hypothetically, let's say your cost of insurance is $100 a month and you're paying $500 a month. That's a $400 excess per month. That excess amount doesn't just go away. It goes into that cash value bucket within the policy. And that's your money. You paid it in there. And traditionally speaking, people will overpay for their policy in the early years and build up that cash value bucket, knowing that when they're older, the cost of insurance is going to be a lot higher than what they're actually paying into it, and you'll have that cash reserve built up to cover that difference.
And a lot of times, I think these permanent life insurance products are sold as a way to build that cash value. They're not even sold as insurance. It's like, look at this money that you can grow over time. But it gets oversimplified and often isn't as efficient as people expect it to be. And it's a big commitment. Like you have that set premium or it may be a variable premium, but large premiums that you have to pay every month in order for it to really grow.
Mm-hmm. So we have that cash value component in there that is often traditionally would be used to cover those excess costs in your later years, and you can math it out to where you pay a set amount for your entire life or for a set number of years, and then your coverage it will be guaranteed to last forever. Simple, easy, straightforward. With some of the newer policies, variable life insurance, for example, you can take that cash value and invest it into sub-accounts, which are very similar to mutual funds. And then your cash value can ride the wave of the stock market. If you're invested in a portfolio and stocks do well, you could see some decent growth in that portfolio. But it could also go down in value. If the stock market goes down, it'll drag down your portfolio with you. A newer version of that are these indexed policies, where rather than tying to a mix of different mutual funds, you can pick a specific index to tie it to. Hypothetically, might be the S&P 500 is a common one, and if the S&P 500 goes up, you get a credit. If it goes down, though, you often get 0 credits, and so you're not actually invested in the market. Your account is just tied to that index. And again, trying not to get too far into the weeds with this, but essentially, when you put money into a life insurance policy, any excess goes into the company's general bond portfolio, and bonds spit out interest. With the interest from those bonds, they'll go out and buy options on the S&P 500 in this example. And an option, if you didn't take any finance classes in college, like I did, it's just your right to purchase something for a stated price. So they'll buy an option on the S&P 500 for, say, what are we at today, like 3,400 points or something. So it might be a 1-year option with the right to purchase it at 3,400. If the S&P 500 a year from now is higher than 3,400, they'll buy it at 3,400, sell it for the difference, and credit your account, whatever that difference is. If the S&P 500 is below 3,400, they just don't exercise the option. They don't purchase it for more than it's worth, and you get 0 credits that year. So you kind of
a really easy way to think about it is that there's a floor and there's a ceiling. So your floor might be 0 or 1 or 2, and then your ceiling might be like 10%. So even if the S&P 500 goes up 18%, you're only going to get 10%.
Correct. Yeah. So there's definitely the cap on the upside, and given interest rates have been low for a while now, many companies have decreased their caps. So we're kind of going in a direction I didn't want to go here, but anyways, so you have a little bit of background understanding, different ways different policies work, that cash value component. There can be some investment gains, but you also have that huge drag of cost of insurance attached to it. So first and foremost, permanent policies, it's insurance. You're getting it for insurance purposes. If that's not your primary reason to get it, then we may need to take a step back and rethink things.
Yeah. Now, so I think like that first step with go ahead, Corey.
No, I was going to turn over to you.
Okay, good. Yeah, sorry. So with insurance in general, like the idea is that we're probably buying this for some sort of protection. Like that's the primary reason for a lot of life insurance policies, but there's a few other reasons that we might be able to utilize life insurance as a tool in our financial plan. So I think the biggest reason that people might want to set up a permanent life insurance policy is to make sure that beneficiaries inherit like assets. It can also be a way when we're estate planning to make sure things are kind of evenly divided among your kids. So maybe if one child is going to inherit your house, like we set up some permanent life insurance so that your other child is inheriting an equivalent to what the value of that house might be. Like there's a lot of different ways that people can use that in estate planning. I think another reason that people might have permanent life insurance and maybe permanent need for life insurance is if you have people in your care that maybe have special needs. So if I have a child that I know is going to need ongoing care long term, and maybe I'm getting to retirement, I'm expecting to spend on my assets, and I might not have a ton of extra to leave behind, like a life insurance policy can be a good way to ensure that they have something when they need it. And I know there's quite a few other reasons. I think estate taxes are an interesting one. Like you can set up a life insurance policy to basically be the thing that pays expected taxes. And in a lot of places, this is only going to be an issue if your estate is pretty large. Like the federal level for estate taxes is like $11 million and above. This does change though. So like that's what it is right now. It doesn't mean that that's going to be what it is when you pass. Like that's just not something that we can predict very easily. And then at the state level, you may also have some estate taxes or some investment or inheritance taxes. So it just kind of depends on what state you're living in at the time that you pass. So life insurance can be used as a tool to basically pay that estate tax bill. And it gets pretty complicated, but that way you can leave the rest of your estate intact for the people that are inheriting it. So whether it's property or investments or anything like that, we don't have to sell property to pay estate taxes. We don't have to sell investments to pay estate taxes if we use that as a tool. Do you have anything to add there, Corey? Did I miss anything?
Well, I think diving a little further into some of those things would be helpful. The real estate one,
Yeah,
the
that
example
one
you
I didn't
gave.
talk about. Yeah.
Well, you mentioned if one
Right.
kid's inherit the house, the other kid's an equivalent value. Some people might be thinking, why don't they just both split the house? Well, maybe you live in San Diego and you have a nice home on the beach there, and you have two children. One of your kids also lives in San Diego and would enjoy inheriting that house to have a place on the beach themselves. Your other kid lives in New York and isn't really interested in having a beach house in San Diego because they'd only get out there once or twice a year and they don't want to deal with maintaining it and sharing the costs. Like, it's just not fair for the kid in San Diego who would get to use the house way more often to share those
Hmm.
costs. So maybe you say, all right, kid number one, you get the $1 million beach house in San Diego. Kid number two, I'm just going to give you $1 million in cash, so it's fair, and hopefully minimize the sibling bickering there.
Yeah, and that way you also don't have to sell the property to make
Exactly.
it equitable. Yeah.
Well, and on along those lines too, like maybe you're invested in a lot of real estate properties. Maybe you have some commercial properties, rental properties, you name it, and some of those properties may have loans attached to them. Um, if you were to pass away with those debts outstanding, you got two scenarios would play out. Either your heirs would have to refinance those debts into their name, which they may not be in a position to afford to do, and they may not even be able to get approved for that new loan. And if that's the case, then they have 9 months to sell the property and pay off the loan. Otherwise, the bank's foreclosing on it. Or they use other assets, have to sell those. Maybe stock market's down. They got to sell investments that are, down in value at that time to pay off the loan. So you might get a life insurance policy to make sure that those debts are taken care of so that your family's not scrambling to figure out how to manage that if you pass away. The estate taxes one, I think, now currently for most people isn't a huge issue,
Mhm.
but that very well could change. This is the highest federal estate tax exemption we've ever seen. I would encourage you guys to go back and listen to our estate planning episode with Bob Cabasi. I think it was last fall of 2019 or last winter. But every time we get a new president, taxes change. I'm sure some of you have, by the time this gets released, hopefully we'll know who the president is. Whether it's President Trump for another 4 years or if Vice President Biden gets the nod. There's chatter around Biden's tax proposal. I don't know if it includes anything about estate taxes, but wouldn't be surprised if that federal limit gets lowered at some point in the future, which would then affect many more people, especially you who are listening to this. And then depending on what state you live in, I think there's 18 states plus DC that either have an estate tax or an inheritance tax. So if you're in one of
And
those
here in
locations,
Oregon, the limit is like $1 million. It's not
yeah,
11 million. One.
and that includes the value of your life insurance, unless your life insurance is held in a trust outside of your estate. But anyways, so yeah, you could very well, between all of your investments, your house, your assets, like you could very well be well above that threshold, depending on what state you're in. If your state has a $1 million limit, you could owe a pretty hefty tax bill upon death. And you may want to carry some life insurance to cover that tax bill so your kids can inherit all of your assets rather than inheriting a tax bill along with it. So the other
And it's
thing,
definitely not something you have to do, but it can be a very useful tool.
correct. Yeah, depending on
Yeah.
who you are. Like, I've talked to some people, no right or wrong way to go about it. Some people are like, I don't really care. Keep it simple. Just if there's taxes, so be it. My kids can just be lucky they get anything. Other
Yeah.
people want as little money as possible to go to the government. They would rather, walk across the country and back barefoot than send a penny to Uncle Sam, and they'll do anything and everything they can to minimize their taxes owed. And this is something that you could do to potentially save hundreds of thousands, if not millions, in taxes at death. Another thing we didn't really touch on, but and I won't spend much time on it, but business partnerships and buy-sell agreements. So if you have a valuable business and let's say Rochelle and I are in business and we own a company that sells widgets, and we sell a lot of widgets, and it's a very valuable business. Maybe it's worth $10 million. And we each own it 50-50. And in our operating agreement, we say if one of us passes away, the other will buy out the shares from the deceased person. So like
whoever inherits it from me. Yeah.
yeah, because the way Rochelle's is set up, her husband and family would inherit all of her stuff. Well, if that includes $5 million of business equity, as much as I like her husband, he's a good golfer, happy to play golf with him, I don't know if he necessarily wants to be in business with me. He may want to just take the cash and move along rather than join the business. And I may not necessarily want to be in business with him. I'd rather just take total control of the business if Rochelle's no longer around. So I pay Rochelle $5 million to buy out her share of the business, and I keep total control of the business that way. Problem is, where am I getting the $5 million from? I might need a life insurance policy on Rochelle to do that. And, you could just get a term policy, but what if we don't really have a defined timeline for how long we want to stay in business? So maybe we get a policy that lasts indefinitely on each other. And that way, if one of us passes away, no matter if it's next year or 30 years from now or 50 years from now, we can fund that buy-sell agreement and a little more seamlessly.
I think one really important thing that I think we're probably going to bring it up later, but I just want to bring it up now while we're talking about it, is that term life insurance can be a really helpful tool because we pay that inexpensive cost right now, but then you can potentially convert it when you have a little bit more cash flow and use it in all of these ways. So, if you're early on in your career and you don't want to make a commitment to permanent life insurance, but you see that it could potentially have some value for you in the future, like buying an inexpensive term life insurance policy is a really, really good way to keep your options open, because most of them have a conversion feature where you can convert into a permanent product without having to do any sort of medical underwriting. So if your health has changed significantly, it doesn't matter. You get to have that same health rating that you received when you purchased the term policy on your permanent life insurance policy. And I think that's such a great tool to just have in your back pocket so that you can keep your options open long term.
And you may be someone who says, I'm never buying permanent life insurance. I don't care. Like I'm anti-permanent, which is fine. Like that's totally great. You never know what life's going to throw at you. And just having that option available is beneficial. And through a company that gives you some flexibility and has some decent permanent products to convert to. So rather than being short-sighted when you're looking at life insurance and only going with the cheapest term option possible, let's dig a little deeper, make sure that the company we're going with allows us to convert that term to a permanent plan, ideally at any point during the life of the term. And also, ideally, they have an array of permanent products available that we can convert to so that we have options, because you just never know. A lot could change in your life. A lot has already changed up to this point in your life. You just never know what could happen in the future. And I mean, the easy example I can give people is, say you buy a 20-year term and year 19, you're diagnosed with a terminal illness. Well, let's flip the switch, convert it to a permanent policy to ensure that your family is getting that death benefit, even if you live beyond the 20-year mark. If it's a terminal illness, you're eventually going to pass. So that's a good way to ensure that they'll get that money. But then, depending on all these other scenarios we just outlined, they could very well apply to you guys in the future. Just having that option available on your term policy so that if your situation is ever faced with one of these scenarios where having permanent coverage could be beneficial, you have that option available to you regardless of health and whether or not your health has changed since you originally got your term coverage.
Yeah, and I think it's also important to note that the differences in cost between different term life insurance policies are not very dramatic. So even going from a very, very bare bones policy where maybe you can convert in the first 10 of 20 years to a policy where you can convert the whole time, and also you can convert into a wider variety of permanent policies, it's not generally going to be a huge cost difference. So I think just making sure you kind of keep your eyes open and are looking at all those aspects when you're even just looking at term life insurance is important.
Correct.
Yeah. I think one other thing we haven't talked about yet is just the potential for using life insurance for some long-term care benefits. A lot of life insurance out there right now has like accelerated death benefits riders, um, which basically mean that you can potentially tap into the value of your life insurance if you have a chronic or critical illness. So that can be really helpful. And many term life insurance policies have that as well, but it just may not last long enough for you to really need to tap into that and use that for end of life care. So I think having that permanent life insurance policy, if you're concerned about those costs, can be really helpful.
Yeah, and some policies specifically have long-term care riders on them and are kind of like a hybrid life insurance long-term care policy where, say, you have
Hmm.
$1 million death benefit, you can also tap into that $1 million for long-term care needs, like to cover the cost of an assisted living facility. So, it'll decrease the death benefit amount for when you actually die, but that's okay. You have that
Hmm.
insurance available should you need it. Now, again, it's not true long-term care insurance. That would be something different, but some people are weary of long-term care insurance, and um, this life insurance option can be attractive for certain individuals who may have a need or desire for that death benefit, but also want to protect somewhat against long-term care, assisted living type costs. So that's another scenario where permanent policies could make sense. And then, do we want to dive a little further into the cash value for those few souls who actually do want to use it
Yeah,
as an investment, or want to hear more
or
about it?
maybe, yeah, or maybe even just cover like the talking points that you might hear from
Or
someone else,
or ask
and
about if you're ever pitched
yeah,
using it as an investment.
exactly. Yeah. So I think like the important thing is that it is very expensive as a product, like permanent life insurance is. And a lot of times when it is sold, it's generally treated as something where it's very tax favorable. And also it has, if it's whole life insurance, it's sold as like this is much more stable than your investment accounts. Like this is guaranteed to be there when you need it at this point in time. And so, there's a lot of that language that's used, and maybe it's driven a little bit by fear too. Like for people who are wary of investment volatility, it might be something that's more appealing, honestly. But I think the reason that it has, well, one of the reasons that it has such a bad rap is that it's sold to so many people who that's the last thing they should be doing. Like they have credit card debt, or they have other expenses and obligations. They're not necessarily like maxing out their retirement plans at work and using those other like tax advantaged vehicles. And then they're sold life insurance that costs thousands and thousands of dollars, and they don't realize until years later that maybe it's not appropriate for them. And then they cancel it with a very, very little cash value in the account because it can take quite a while for that to actually start to build up. And they just feel like it's a big, giant waste of money. And for them, it probably was. Um, so I think that's one thing. But on the positive side, it can provide some tax advantages. Like there's some truth to that. There are ways that you can borrow against the cash value in a life insurance policy if you structure it correctly and not pay taxes on the amount that you borrow because it's technically a loan. And then it's also more protected than a lot of like brokerage account or investment account assets in a lot of states. So if you have some sort of claim filed against you, for example, and you're in a state where, I mean, they can generally come up after your investment account assets, or at least your non-retirement assets, but your insurance value, like the cash value in your insurance, might be a lot better protected than that. Um, and
Depends
then,
on the state, and you definitely want to
yeah,
consult with an attorney regarding your
absolutely.
specific state regulations, but that is true. In certain states, it can be a highly protected asset.
Yeah, absolutely. And then there is some truth that market returns are unpredictable, obviously. We know over long periods of time, like we hope to see certain rates of return, but we don't know exactly what that's going to look like. And I think over a long periods of time in the past, we have seen if you weigh the costs and things like that, that general investment vehicles do a lot better as far as rates of return than permanent life insurance policies. But we don't know what's going to happen in the future. So if you choose to do something with a permanent life insurance policy that has a little bit more structure and is a little bit more protected against any sort of downturns in the market, then it's possible that could perform better over time. And I have seen it used almost like a buffer for your investment accounts so that your investment accounts can be more aggressive. And I don't know, Corey, you could probably talk about this a little bit better, but sometimes when we're building out investment account allocations, like we have a little bit in bonds because that's kind of some protection on the downside. If the stock market's not doing well, but we have a little bit in bonds, then maybe the bonds are doing okay in that market. But over a long period of time, stocks tend to perform better. So if we can keep our investment portfolio more in stocks and equities and take advantage of hopefully a higher rate of return over time, but have that life insurance vehicle as maybe that protection on the downside, then that can be a way to sort of insulate your investment risk. But can you, yeah, Corey, you go. I feel like I'm butchering it.
No, it's spot on. Yeah, I think the scenarios where it actually works and makes sense, it's a very small, unique scenario or set of scenarios, definitely not for the masses. Until you're maxing out your 401k or 403b at work, maxing out your IRAs or backdoor Roth IRAs, and you've already fulfilled, and you're maxing out all of your traditional tax favorable vehicles, you're putting money into a flexible brokerage account, and you're looking for additional places to invest that to further diversify and also offer some tax benefits, then that's when we can start exploring some of these alternative investment vehicles, such as life insurance. And you definitely don't want to put a large portion of your net worth in there. But from a diversification standpoint, like Rochelle mentioned, the tax component, it's a tax sheltered vehicle. So the investment value, any growth is tax deferred, and then if it's done correctly, you can actually borrow against your cash value tax free because it's technically a loan, and it's your own money, so you're borrowing against yourself. You don't actually have to pay that money back if you don't want to. The loan balance would just come off of the final death benefit when you pass away, because again, it's your money. So if it's structured correctly, it can work favorably, but understand there is a significant cost of insurance to it. So it's, all else being equal, probably not going to perform as well as a traditional investment account that doesn't have a cost of insurance attached to it. But also, like Rochelle, you said, many of those policies, excluding variable, but like whole life and like index universal is probably the more appropriate if we're looking at investment potential. You have a floor, often 0%. So the investment bucket won't go down due to market performance. You're capped on the upside, but the downside is limited. And for some people who may be wary of the stock market and are okay accepting that higher cost of insurance for something that has a little bit of downside protection, if you will, for lack of a better term, that can be attractive. And really the only way that works well is if you put as much into the policy as you're allowed to put in order to still maintain the tax benefits. So that I mentioned that tax deferred growth and tax-free loans, you're only allowed to borrow from your policy tax-free if your policy meets certain guidelines, because otherwise you would just say, all right, I'm going to just set my cost of insurance at $1, have $1 of life insurance and put, tens of thousands into it. And then my cost of insurance will be super low and I'll get all this tax deferred growth and it'll be great. They don't let you do that. You have to, for every dollar you put in, you have to have a certain cost of insurance in order for it to be considered a life insurance policy and not an investment account. But there is a pretty generous range there. So in order to really make it work, if you're going to explore it, you really do have to maximize the amount you're putting in consistently for a long time.
That's a big commitment.
Like, you got to stick with it for a good 10, 15 plus years. Otherwise, you're probably better off doing something else. But if you do stick with it, and you do put the maximum allowed into it over time, that tax deferred growth can add up, and it can be a nice diversification tool from something that's fully exposed to the ups and downs of the stock market. Not for everyone, not appropriate for most of you, but for certain individuals. Like, I've talked to some people who are like, I do not like the stock market. It scares me. I want protection. I also want to leave money to my kids. I need, insurance and yada, yada, yada. I've got all this extra money that, because I've done a good job planning, and this is something that I like to explore for these reasons. Great. All right, let's do it. But unless you really understand what you're getting into and are on board with the commitment you have to make it worthwhile, probably not worth it.
Mm-hmm. I think if you have any questions about it, if you are at all doubtful, don't do it. Like, I feel like it's a tool in your tool belt that you could potentially use, but if you don't use it, it's not going to make or break your plan. It's not like you need permanent life insurance to make the plan work, generally speaking. So,
Correct.
if there's another way that you can go about it, then do that, unless you really feel like it's the best thing for you. And do you really think that you can make a solid commitment to fund it appropriately over a long period of time? And it is a really big commitment. I think there's a lot of things that almost automatically rule it out for you. Like, if you're a person that has credit card debt, you're a person that struggles to pay their bills, if you're a person that's not saving enough for retirement and you're not saving enough for retirement, if you're not maximizing like your plans at work, if you're not funding a Roth IRA, it's probably not appropriate unless there's some very, very specific life insurance needs that you have.
If you have a high income, you're living below your means, you're maxing out all your traditional investment vehicles, you're already putting a large amount into a taxable brokerage account, and you're looking for an alternative vehicle to further diversify your plan, it can make sense. If it's done right and done well, it can work out favorably. The problem is most people don't use it for the right reasons, and most life insurance agents don't set it up appropriately for their clients or customers, if you will. So it's really important that you proceed slowly, ask questions, and you're working with someone that understands what you need to do to ultimately align it with your goals and get the most out of it.
Definitely. I think if anyone has questions, feel free to reach out to us, because I know that this is a very, very complicated topic. Like, we're touching the tip of the iceberg on this one. But I do think it's something that we get a lot of questions about, and we do come across people that have full life insurance policies they've had a long time, and maybe they've pumped a lot of money into it, and it's just, it's really discouraging when they realize that maybe it's not the best fit for them and they can't go back and get all that money back. So that can be a really challenging thing to think about.
For sure. All right, you guys, thanks for listening. Until next time.
We would love to hear your feedback and suggestions for future topics you'd like us to cover. You can get in touch with the show by emailing podcast@thefinitygroup.com or by following Finity Group on Facebook, Twitter, Instagram, LinkedIn, and YouTube at Finity Group LLC.
You can follow me on Twitter at Corey Janoff CFP, Instagram at Corey Janoff, or on LinkedIn under my name, Corey Janoff.
You can follow me on Twitter at Rochelle Finance, or on Instagram, Vanderzanden Rochelle, or on LinkedIn under my name, Rochelle Vanderzanden.
Check out all of the podcast episodes on the finitygroup.com/podcast, on our Finity Group YouTube channel, or your favorite podcast app. And don't forget to check out our Financial Clarity blog at thefinitygroup.com/blog.
Thanks for listening to this episode of Financial Clarity for Doctors by Finity Group LLC.